Iran declared the Strait of Hormuz closed again on Saturday, just hours after President Trump announced it was completely open and ready for business. That whiplash wiped out a single-session equity rally and sent oil climbing back above $85 a barrel. The gap between Trump's announcement and Iran's reversal was less than 24 hours. What happened in between reveals a fracture inside the Iranian regime itself. Foreign Minister Araghchi declared the strait open. The Islamic Revolutionary Guard Corps immediately contradicted him, calling it a complete lack of tact. Since Supreme Leader Khamenei was killed in February, the IRGC has taken on the role of final arbiter, and the IRGC has no interest in a deal that surrenders the one choke point that gives Iran leverage over the global economy. 20% of the world's seaborne oil transits the Strait of Hormuz. With the strait only partially functioning, the disruption has already produced the largest monthly gasoline price surge on record in Canada, 21.2% in March alone, lifting headline inflation to 2.4%, the highest in 2 years. The U.S. is not immune. March CPI came in at 3.3% year-over-year, the fastest print since June 2022. WTI crude is holding above $85. Analysts at BMO expect April inflation to top 3%. The Pentagon is now preparing to board Iran-linked tankers in international waters, not just those near the Persian Gulf. At least 5 Iran-linked tankers bound for Malaysia have already changed course to avoid the U.S. Navy. The squeeze on Iranian oil revenue is real, but the IRGC has learned something useful. It does not need a formal closure to destabilize global shipping. Firing on one vessel produces the same economic fear. Talks resume in Islamabad Tuesday, with fewer than 48 hours left on the ceasefire. 3 former U.S. diplomats told Fortune they are not confident a deal is reachable on this timeline. The oil shock lands at the worst possible moment for the Federal Reserve, and for Kevin Warsh, Trump's nominee to lead it. Before the war, markets had priced in 2 rate cuts for 2026. That expectation is now gone. Fed funds futures price essentially no chance of a cut at the April 28-29 meeting, and roughly even odds of a single move before year-end. The pivot from 2 cuts to maybe 1 happened in a matter of weeks, driven entirely by energy prices. Into that environment, Warsh walked into his Senate confirmation hearing Tuesday and said something the White House did not order. Inflation is a choice, and the Fed must take responsibility for it. He added, "Low inflation is the Fed's plot armor. When inflation surges, grievous harm is done to our citizens." That is the language a central bank chair uses to justify holding rates, not cutting them. Trump nominated Warsh precisely to deliver rate cuts. Warsh is telling the Senate that the Fed, not the White House, has the last word on monetary policy. He drew a sharp line. Presidential commentary on interest rates is constitutionally permitted, but the monetary policy lane is closed to outside traffic. Prediction markets still put his confirmation at 94%. But the gap between what Trump expected from Warsh and what Warsh delivered in his opening statement is now visible. The dollar has been weakening. Sterling crossed 1.35 against the dollar Monday, its highest level in years, driven partly by the expectation that a hawkish-sounding Warsh markets won. While energy and the Fed pulled markets lower Monday, one story ran against the grain. Amazon announced it would invest up to $25 billion into Anthropic, on top of the $8 billion it had already committed. Anthropic, in turn, pledged more than $100 billion in AWS compute spending over the next decade. Amazon shares rose 2.55% after hours. The numbers tell the story. Anthropic's annualized revenue has climbed from $9 billion in December 2025 to $30 billion in early April 2026. That is a near tripling in 4 months. AWS is estimated to capture roughly 60% of Anthropic's cloud spend. KeyBank expects 30% year-over-year AWS growth in Q1, potentially accelerating from there. Amazon's Trainium trips are already generating more than $20 billion in revenue, triple-digit growth year-over-year. That backdrop runs directly against the macro headwinds. If energy-driven inflation persists and the Fed stays on hold through year-end, borrowing costs remain elevated. High-multiple AI stocks are the first to reprice when the rate outlook tightens. Amazon trades at a premium that prices in continued hyperscaler dominance. Apple added its own uncertainty. Tim Cook announced he will step down as CEO on September 1, handing the reins to hardware engineering chief John Ternus. Apple fell 0.8% in after-hours trading. The tension here is a structural one. The Amazon-Anthropic deal confirms that AI infrastructure spending is accelerating regardless of macro conditions. Anthropic CEO Dario Amodei described demand as unprecedented, citing inevitable strain on existing infrastructure. But the same energy shock that is driving inflation and keeping rates elevated raises the cost of every dollar of future AI capital expenditure. Both things are true at once. The weight of evidence points toward the oil shock remaining the dominant variable in the near term. The ceasefire deadline passes Tuesday. If Kushner and Witkoff return from Islamabad with a credible agreement and a committed timeline for reopening the strait, rate cut expectations could rapidly reprice, and with them, equity valuations. If talks collapse, energy prices stay elevated, the Fed stays on hold, and Warsh's inflation-first framing becomes the central narrative for every earnings call through the summer. Watch two numbers: White TI crude on Wednesday morning following the Islamabad talks, and the Fed's April 28-29 statement language on the inflation outlook. If crude drops below $75 and the Fed flags energy as a transitory factor, the recovery scenario becomes viable. If crude holds above $85 and the Fed statement omits any easing bias, the risk asset repricing has further to run. The leaning could be wrong in one specific way. Iranian factional politics is unpredictable. If a reformist faction inside the regime gains enough leverage to push through a genuine deal, not a press release, but a verified reopening with IRGC backing, the entire macro picture reverses in a session.